US GAAP ASC 740 Income Tax, the complete accounting masterclass. Hello and welcome to CandiMentor. Today, we decode US GAAP ASC 740 Income Tax, one of the most technical topics in US financial reporting. This session is designed to help you understand the foundations of tax accounting, build confidence in applying the standard, and strengthen your skills for real-world financial reporting and analysis. Before we begin, hit subscribe to CandiMentor. What ASC 740 is, the purpose and big picture. ASC 740 explains how companies account for income taxes in US GAAP financial statements. It covers current tax, deferred tax assets, deferred tax liabilities, uncertain tax positions, tax effects in OCI and equity, disclosures required for users of financial statements. At its core, ASC 740 exists because financial reporting income and taxable income are rarely the same, and the standard provides the bridge. Temporary differences, the foundation. A temporary difference is a difference between the book basis of an asset or liability and the tax basis used for tax filings. Temporary differences create deferred tax liabilities when taxable income will be higher in the future, deferred tax assets when taxable income will be lower in the future. Example: book value of a machine, $100,000, tax basis, $60,000. Difference: $40,000, tax rate, 25%, deferred tax liability, $10,000. This principle sits at the heart of ASC 740. End of. Taxable versus deductible temporary differences. Taxable temporary differences, deferred tax liabilities. These increase future taxable income. Examples: accelerated tax depreciation, revenue received but not yet recognized in books, fair value gains not yet taxable, step-ups from acquisitions. Deductible temporary differences, deferred tax assets. These reduce future taxable income. Examples: warranty provisions, allowance for doubtful accounts. Stock-based compensation timing differences, lease liability exceeding ROU asset, net operating losses. Current tax and deferred tax. Two sides of tax accounting. Current tax, tax payable for the current period based on taxable profit. Deferred tax, tax effects of temporary differences that will reverse in future periods. Think of it this way: current tax reflects this year, deferred tax reflects future years. End close. Valuation allowance, assessing whether deferred tax assets are realizable. A valuation allowance reduces deferred tax assets when it is more likely than not that part of the asset will not be used. Factors considered include history of losses, forecasted taxable income, tax planning opportunities, nature and expiry of attributes, economic trends. When needed, full debit, income tax expense, credit, valuation allowance. This is one of the most judgment-heavy areas in ASC 740. The end. Uncertain tax positions. Understanding FIN 48. ASC 740 incorporates the FIN 48 model for uncertain tax positions using two steps. Step 1. Recognition. A tax position is recognized only if it is more likely than not to be sustained upon examination. Step 2. Measurement. Recognize the largest amount of benefit that is more than 50% likely to be realized. Example: tax deduction claimed, $100 likely sustainable. $60. Recognize benefit of $60. This model ensures conservative and consistent recognition. Intraperiod tax allocation, matching tax to the proper section. Tax must be presented where the underlying item appears. Allocate to continuing operations, discontinued operations, OCI items, equity transactions. A simple rule. Tax follows the item. End. Tax rates used for deferred taxes. Enacted rates only. Deferred taxes use enacted tax rates under U.S. law. Proposed or draft rates cannot be used. State tax effects are blended based on apportionment. When a tax law changes, deferred taxes must be remeasured immediately. Deferred taxes in business combinations, linking SC 740 and SC 805. Business combinations require fair value measurement of assets and liabilities, comparison of fair value to tax basis, recognition of deferred tax assets and liabilities, adjustments to goodwill. Example, fair value uplift on inventory, deferred tax liability. Acquisitions produce some of the largest deferred tax balances in US GAAP. That's indefinite-lived assets and net operating losses. Indefinite-lived intangibles. Temporary differences may not reverse on a predictable schedule. Net operating losses, NOLs, under current U.S. rules, can be carried forward indefinitely, can offset up to 80% of taxable income. Even with indefinite lives, valuation allowance still applies. State taxes. Additional layer of complexity. ASC 740 requires consideration of state-specific rates, apportionment, state NOL limitations, state valuation allowances. Companies often have dozens of state-level temporary differences. Outside basis differences, subsidiaries and investments. Temporary differences also arise from ownership of subsidiaries, joint ventures, and equity method investments. Deferred tax liabilities are recognized unless the parent can control the timing of reversal, and evidence shows reversal is not expected in the foreseeable future. Deferred tax assets on outside basis differences require probable recovery. Interaction with U.S. international tax rules, GILTI, BEAT, and more. ASC 740 interacts with modern tax rules. GILTI. Companies may choose to recognize deferred taxes or to treat GILTI as a current period tax. BEAT affects current tax, not deferred tax. FDDEI influences effective tax rate reconciliation. Understanding these rules is essential for multinational groups. Journal entries. Clean and simple. Current tax. Full debit. Income tax expense. Credit. Income tax payable. Deferred tax liability. Full debit. Income tax expense. Credit. Deferred tax liability. Deferred tax asset. Full debit. Deferred tax asset. Credit. Income tax benefit. Valuation allowance. Full debit. Income tax expense. Credit. Valuation allowance. These entries appear in almost every 10K and annual audit. Numerical example, a simple walkthrough. Book depreciation $10,000, tax depreciation $20,000, difference $10,000, tax rate 25%, deferred tax liability $2,500. Journal entry, full debit, income tax expense $2,500. Credit, deferred tax liability, $2,500. This example clearly shows the mechanics. Disclosures. What high-quality reporting includes. Required disclosures include current versus deferred tax components, detailed list of deferred tax assets and liabilities, valuation allowance movements, effective tax rate reconciliation, unrecognized tax benefits roll forward, NOL and credit carryforwards, tax effects in OCI and equity. These disclosures allow users to understand tax risk and tax strategy. Key concepts to master. Be comfortable explaining what temporary differences are, how deferred taxes are measured, how valuation allowances work, what uncertain tax positions require, how tax effects move between P and L, OCI, and equity. How business combinations create deferred taxes. How changing tax rates impact deferred taxes. These concepts are fundamental to modern financial reporting. Final wrap, ASC 740 is the backbone of U.S. tax accounting. It links book income to taxable income, captures future tax consequences, and ensures consistent reporting across current tax, deferred taxes, valuation allowances, and uncertain tax positions. Once you understand temporary differences, the rest of ASC 740 becomes logical and structured. If you found this helpful, subscribe to CandiMentor. We are building the world's best learning hub for accounting, finance, and global reporting, and you should be part of it.